you can help solve it too. So anyway, we really want you there. We're going to help you unfuck your future. Come and join us. All you have to do is go to realvision.com/the future, and it's going to cost you $1 to join Real Vision for 14 days. And I promise you, it's the best dollar you'll spend in your entire life. See you there. Hi. On June 5th and 6th, 2024, I'll be speaking at the largest AI event in Asia, Super AI, in Singapore, at the iconic Marina Bay Sands. Alongside brilliant minds like Benedict Evans, Balaji, and Edward Snowden, I'll be on stage exploring the extraordinary potential of AI and the profound change it represents, not just for financial markets, but for the world as we know it. With over 5,000 attendees and over 150 side events, Singapore will become a vibrant AI hub for a full week from June the 3rd to the 9th. Visit realvision.com/super AI to register and join me with 20% off tickets with the code REALVISION, all in caps. Hi everyone. So today I'm going to talk to you in my other persona, which is Raoul from Global Macro Investor, because Real Vision doesn't have a view on stuff, but I personally have a view, and I've spent 30 years developing that view, of which 20 has been since 2008, and really exacerbated by the time we got to the European financial crisis. So there's a shortage of dollars, there's a shortage of global lenders because of Basel III and the agreements with the banking system. So the dollar rises. Okay, fine, we can deal with that, and that's part of Brent Johnson's dollar milkshake theory. But more importantly, when we look at global equity markets in dollar terms, they haven't gone up. See, here's the MSCI world. It basically hasn't gone up since 2008. When we look at, let's say, a country like Spain in Europe, Spain, I was there over that period of time. It was a terrible situation. Spanish stock market in dollars hasn't gone up. Italy, dollars, hasn't gone up. The Euro stocks in dollars hasn't really gone up. The FTSE in dollars hasn't really gone up. MSCI emerging markets haven't gone up. They've gone nowhere since 2008 in dollar terms. And the same with Shanghai. So the Chinese equity market or the Bloomberg commodity market peaked back then. There's only a few markets that have outperformed this. And those are the ones that I've talked about in the past. Those were technology. So it's harder and harder to get debt. Also, asset prices have risen so much that we would have to borrow too much money to actually buy into asset prices. So it's kind of fucked us there. So we've now been fucked because asset prices are rising and we can't borrow money to even get into the property market, but they're also becoming unaffordable because our wages never went up. Okay, so those are the two of the key reasons why we're fucked. Now, what we need to do is figure out, okay, what does this all mean? Now, what I've shown from all of this is that really the governments have just offset the debt growth via the printing of money. And the balance sheet keeps going up. And that is the debasement of currency effect that is so pernicious. You've got to think of debasement of currency as a hidden tax on everybody. It's basically, if they're debasing currency by using, let's say, total global liquidity, and that's the US, Europe, Japan, China, the UK. If they're debasing by about 15% on average, then we're all getting 15% poorer in terms of our income buys less assets because the assets optically rise, incomes don't. It's also, I've just explained that debt growth broke in 2008, not coming back. Population growth also peaked back then too. It started peaking in 2000. And what we've seen is things like the labour force participation rate fall. And this is the bigger story, the demographic story behind which this is all driven. Peak humans have created the problem of lower trend rates of GDP. Peak humans are what we face in our future. So the labour force participation rate in the United States, as the number of people who are active in the labour force, has been declining. So that means there's less productivity because we've got this aging population. Also, there's less industrial production because less people are in the labour force. It kind of makes sense, right? So it's a problem that is going to continue because when we look at forward-looking elements, the working age population in the US has been falling over time. most countries in the world are actually shrinking now of the major developed economies. We're seeing stories of Taiwan having to import Indian workers. We're seeing the rise of robotics to off-place these missing workers. It's a global problem that the global economy is facing right now, and it is going to the entire system. You can't let that go down. You were able to let the bond market go into free fall because the bond market mainly is held without mark-to-market on the balance sheet of insurance companies and the banks. Yes, it created bank problems. I won't go into that one now. I mean, I could speak for hours about all of this, so I'm sorry that I have to jump around and get through, but there's a lot to try and get through. So the peak humans issue is another big problem here because people don't understand what that really means. It means tax revenues go down because they're not paying taxes because they're not earning a living. They also want to divest assets because they need to realize the assets to pay for their retirement. So we need to somehow orchestrate a changing of that. And what we're seeing is that the younger generation are buying passive products. Passive products drive up the value of those equities. The baby boomers are divesting themselves of active management products because that's what they grew up with. That's creating this spread between so many of the things we see today, value stocks for returns for the last 7 years, 8 years. It's actually higher if you go back earlier in Bitcoin's time. But if you basically look at that, you're going to get somewhere between 80 and 200% returns, depending where you are on the cycle over time. So these are the compounded returns. These aren't just, year in, because obviously some years you're like 500% returns and other times you'll make down 70%. People don't get their heads around, but this is actually the best risk-adjusted reward asset of all time. Fidelity have this beautiful chart of all of these dot plots of risk-adjusted rewards of assets. And there's tech is quite high and, some markets are high, and then cyclical stuff like oil and stuff is low risk-adjusted returns over time because it doesn't really do anything. All of this, S&P, all in this. And then you go and there's a blank paper, and somewhere right at the top is a dot that says Bitcoin. It's a fucking alien. We have never been given an asset like crypto. That is just the investment in the infrastructure layer of this new digital economy. Obviously, the applications layer, what we do with this technology goes on top, but we're having a chance to invest in the applications layer here. I'm sorry, in the actual infrastructure layer. It's like owning a share of every single mobile phone network added together. If it was a public good, like the internet, owning a share of the internet, that's what we're buying here. It's a share of the rails of the new future, and everybody can own it. It's a public good, but we own it, as opposed to a public good being free like the internet. It's a public good that we can own a part of, and owning a part of it means we have behavioral incentives to make it grow, so it grows faster than anything else. Because the more people who join the network, the more the value of the network goes up, the more applications get built on the network because of the value of the network increases the value of the network, and so on and so forth. This is why it's the fastest adoption of any asset class the world has ever seen. Asset class, AI is a technology, but of an asset class, this dwarfs anything else. The last numbers we saw, we were